Our weekly economic outlook, and for that we are joined by Paul Dietrich of Foxhall Capital Management. Thank you for being with us, Paul.
Thank you.
All right, so your notes that you sent us say we have a rotten recovery in private and corporate investment, but not in consumption, and this is important. Why?
Well, you know, we're seeing consumer surveys that are showing negative ratings that we haven't seen since 2007 when we were coming out of the recession. But consumer confidence surveys and actually consumer spending are not necessarily the same thing. If you look at the Federal Reserve figures, you'll see that consumer spending has in fact been going up in a fairly steady pattern. But what we're having problems with in this recovery is private and corporate investment. One of the things, I actually believe that consumer confidence surveys are kind of bottoming out, and we know that because there are three patterns that one sees when consumer confidence is bottoming out. One, you see capitulation views by consumers. Secondly, you also see consumers acting differently than their negative mood. And in the most recent consumer surveys, we were seeing when they asked the question, are you planning to buy a big ticket item soon, like a vacation or a car, an increasing number of people were saying yes to that. And then thirdly, we're seeing actual numbers from consumer corporations that actually verify that pattern. We're seeing General Motors, which last quarter sold 37% more cars than the previous quarter. We're seeing Visa and MasterCard over the last 3 or 4 months going up 7, 8, 9% during that period of time. We're seeing Costco and Walmart and those types of companies with 4 to 8% growth. And we're seeing state and local sales taxes up about 5%. So all of these indicators, and I believe these are more leading economic indicators as opposed to the lagging government indicators, are all sort of pointing in a positive direction. And historically, that shows a bottoming out.
All right. Now, you are long-term bullish on the stock market, and you do not believe that the U.S. is headed for a double-dip recession.
No, one of the things people keep asking me is how can U.S. corporations be doing so well in their earnings when the U.S. economy is growing at such a almost flat pace? And the answer is that the U.S. stock market over the last 3 or 4 years has almost completely decoupled from the underlying U.S. economy. Right now, 50% of earnings are coming from outside of the United States for both Dow and S&P 500 stocks. So the U.S. stock market actually represents as much of what's going on in the fast-growing economies of Asia and emerging markets as it does here in the United States. And if you look at the fundamentals of companies, they've just never looked better. I mean, most companies have a $1.3 to $1.7 trillion in cash in the S&P trillion in cash in the S&P 500 companies. Most have very low debt, and what debt they do have is long-term and at very low rates. And earnings are going up 16 to 17% this year. And under normal circumstances, if the price-earnings ratio stayed the same, you know, we'd have a 16 to 17% growth in the stock market by the end of this year. And I actually believe that once we get over this European debt crisis, and once that's solved, and I think we'll see that in the next 4 to 6 weeks, then I think the stock market is really going to take off and people are going to focus on fundamentals. And I still believe we're going to have a good year at the end of this year for the stock market.
And 4 to 6 weeks to get out of the European debt crisis. That's good to hear. There is, of course, a new congressional supercommittee which has the daunting task of trying to come up with the spending cuts needed to help lower the budget deficit. 6 Democrats, 6 Republicans. You have an idea for the first question that this committee should be asking. What is it?
There's only one question that this committee should be asking at the very beginning, and that is, how much can government spend of GDP before we either flatline as an economy or we go into permanent decline. From 1960 to 2000, basically the U.S. government spent, even during the Vietnam War, anywhere from 18% to sometimes as high as 22% of GDP during that period of time. And we know from 1960 to 2000, we had really spectacular growth during that period of time. So we know that 18% to 22% of spending to GDP, we can have growth in the economy. Now we're at 25% spending of government spending to GDP, and we have flatlined. Nothing the government is doing will actually help the economy. Nothing the government, all the stimulus program, nothing seems to work. And if you look over the next 10 years with baby boomers retiring and joining all the entitlement programs of Medicare and Social Security, what you're actually seeing is that we're going to be going up by 2012 to 27, 28% of GDP. And I believe at that point, we're probably flatlining now, and at that point we're going to go into permanent decline. And I don't believe that either Democrats or Republicans want to see our economy go into permanent decline. And so I think the first order of business is to set how much money, and it's probably around 22% of GDP that the government can spend before we start going into flatline or decline. And then at that point, everything else falls into place. You really know how much you have to cut, and if there are tax increases at some point in order to balance the budget at 22% of GDP, then we know what that is also.